Well, welcome back to the Money Wisdom Podcast powered by Johnson Brunetti. My name is Jake Dozer. I'm a certified financial planner and certified private wealth advisor here on the team in our Connecticut offices, joined, of course, by Nick. Nick, would you introduce yourself to those who haven't tuned in before?
I'd love to, Jake. Thank you for the floor. Viewers, listeners, welcome back. I'm Nick Colantuno. I'm a certified financial planner up here in our Boston, Massachusetts offices. We're glad you're all with us today.
All right. Well, we're looking forward to our episode today. One of the big topics that has been on discussion lately has been the big, beautiful bill. Whether you think it's beautiful or not is not the topic of discussion today.
It is big.
It's big, that's for sure. And we tend not to hop into politics, but more want to interpret, regardless of our sentiments about those things, what is the impact to me, right? And that's really what the bottom line is what does this mean to my plan? That's the question we should be filtering everything we watch economically through, so that we can make informed decisions. And so to that end, the question we have in front of us today is, can you really pay less taxes on Social Security? That question, of course, is akin to the question that was on a lot of our minds before July 2025 when this bill passed, which was, is Social Security going to be taxable at all? So let's clarify some of that. At this point, I think there's a much more clarity than there was even a month ago. But Nick, in simple terms, help us understand, is Social Security taxable?
Yes. So Social Security is taxable at the federal level, no matter what state you live in.
Yeah.
This is, Jake, where your clients and my clients might have things a little differently. Here in Massachusetts residents do not pay state income tax on their Social Security. Keep in mind, that saves them, from paying about 5% or so tax on the money that they receive from Social Security. So again, federally, they pay, federal income tax on Social Security, but no state income tax.
And whereas in Connecticut, we do pay state income tax on Social Security. However, since 2022 and rolling into this year, the government passed at the state of Connecticut level, passed some legislation that started lessening the tax. So namely, what happens is income sources, Social Security, pensions, annuity withdrawals, and IRA withdrawals are not subject to state income tax under certain conditions. If you're a single filer, it's if you make $75,000 of adjusted gross income or less. And if you're married filing jointly, it's $100,000 or less. And as of the last time I saw, it is a cliff, meaning if you go one penny over it, you retroactively pay tax on the whole shebang at the state income tax level. Now, in fairness, one quick fairness is, the state of Connecticut oftentimes is looked at as a high state income tax state. And theoretically, it could be high because it goes all the way up to 6.99% of state income tax. But most of the time, if your income as a married couple is $100,000, your state income tax might be like 3%. So it's not, in reality, for the average income earner, it's not a huge state income tax state. It's a huge tax state because we have excise tax and we have real estate tax that you pay through the nose for. But the state income tax is not super burdensome. But that's kind of the rules with the state of Connecticut. A little bit not as cut and dry, but here we are. So we talked about the state aspect of Social Security, and Nick put it in plain words that Social Security is still taxable. Nick, help us to understand, what is this big, beautiful bill? What does it mean for federal taxation of Social Security, as far as both how can Social Security be taxed? You've broken down that as before, the levels of taxation, and then also what the new standard deduction rules are.
Yeah, so the standard deduction has certainly increased, which is nice, and we'll talk about that a little bit. But it's also important, folks, to remember that you won't pay taxes on all of the money that you receive from Social Security. So they do a calculation, and it's all based on your modified adjusted gross income. This is where we get a little into the jargon and a little deeper into the weeds than I would tend to like on this type of an episode. But the way to think about it is you basically take all of your earned income, all of your non-taxable interest and dividends, and then you take about half of your Social Security benefit. And depending on what that number is, that's going to determine how much of your Social Security is taxable. So again, you can pay taxes on none of your Social Security if you have that modified adjusted gross income below a certain level. You can pay taxes on 50% of your Social Security benefit. if it's within a certain threshold, or if you're on the higher end of the modified adjusted gross income range, you could pay taxes on up to 85% of your benefit. So what this really means is everyone, regardless of how much money you're making, will at least get 15% of their Social Security benefit that will not be subject to the federal income tax. So again, there's a lot to unpack there, and that's where it's just so critical to make sure that you're having these conversations with your advisor. You know, Jake, you're obviously as familiar with this as I am, but these are the real nuts and bolts of the conversations that we're having every single day with our clients. You know, a lot of people come in and they're sitting down with us for those consultations, and they're asking about this stock or that bond, and oftentimes I have to put my foot on the brake and say, whoa, let's focus on the bigger picture things that matter the most. And in retirement, it is so critical to have those conversations, not just about what's coming in, but what's going out, right? It's not just what you earn, it's what you keep. And so that's where taxes are a huge part of it. And I understand where this viewer's question is coming from, because oftentimes the taxes on Social Security are just, they almost hit you in the 11th hour, right? It's like the last thing people are thinking about when they go to file for Social Security. So critical part of what we're talking about. So you mentioned the standard deductions.
Right.
So again, married couples filing joint taxes, you get about a $30,000 standard deduction. Now they have additional deductions that can be added if you're over 65, or again, if you're married versus single.
Right.
So individuals 65 and older can actually get an extra $6,000 deduction on top of that standard deduction. And they carried that $6,000 over even for married couples, except it's double because there's two of you.
Right.
So again, a married couple, if you're 65 or older, you get the $30,000 standard deduction, and then you can deduct an additional $12,000 on top of that. That's $42,000 of deductions, which is fantastic. Now, keep in mind, nothing for nothing here, folks. So they will actually phase those deductions out.
Right.
If you're a single tax filer, the phase out starts at around $75,000. And again, it's all based on that modified adjusted gross income number, and they double it for married couples filing jointly, so roughly $175,000. So I know, again, throwing numbers at you in a podcast episode is not ideal, so have these conversations with your advisor. They're critical things to discuss.
And you're exactly right. My takeaway from that, as I'm listening to you describe how to calculate MAGI, or modified adjusted gross income, it's adjusted gross income versus gross income is a complicated enough topic when you don't do this for a living. And then when you add an extra layer of complexity of modified adjusted gross income, and different income sources tabulate differently when you're calculating these numbers, and some benefits apply to you if you calculate above that threshold and some don't. And different states have different rules. My takeaway in my mind is, man, tax planning is a daunting area to be doing it yourself. Not to say that it can't be done, but I don't know about you, Nick. I don't even do my own tax planning, and I do this for a living. I use Karen, our CPA, on staff. But I guess the point is if I'm a listener, I'm thinking to myself, is this something that I'm truly looking to endeavor in on my own? Do I need direction and guidance? And let's talk about one final piece, which is the pragmatic piece, which is, okay, I understand the parameters. I understand Social Security is taxable. I understand that it's taxable in the state of Connecticut at an income tax bracket. In Mass, it's not. I understand that other income sources adding it to it can complicate the pot. What do I do about it, right? Because the goal is, all right, now that I understand it, how do I control the taxes I pay? And so I think it's important to keep in mind that there's a few different ways to control those taxes. Of course, it's the timing of your retirement account withdrawals. Which account you withdraw from at what time impacts these things. And I'm thinking about the average timeline of the clients with whom we work. I'm thinking about, if you want to retire early, well, now you have to make a decision of, do I take Social Security right away? Do I delay it? You need to make a decision of, if I need health insurance outside of my work, but I'm not old enough on Medicare, my health insurance is impacted by my income level. I'm thinking about making sure I don't take my income so soon that I run out, but I also don't delay it so long that I don't enjoy the benefit of it. And then finally, if you're 65 or older, you're thinking about, okay, what about getting ahead of my future RMDs? If I don't withdraw enough early in retirement, my RMD, my required distribution at age 73 or 75 might be a lot, and it pushes me to a higher tax bracket later. And if it does that, not only could I go into a new federal tax bracket, I could go from state income tax of nothing to state income tax of something in Connecticut, and I can get hit with a Medicare surcharge. So again, not only are all these pieces on your tax form complicated, but the way to plan to proactively pay less taxes is complicated. And man, your head's swimming. Nick, how do we solve this? I mean, in a word, I'm thinking income planning, but give us 60 seconds of how do we put all this stuff together?
No, I mean, you're absolutely right. It's complicated. And folks, there's a lot that gets thrown at you. And hearing you, Jake, rattle off those 6 or 7 concerns, in my mind, I'm thinking, man, that's our next 6 or 7 podcast episodes right there. Because, I mean, those are just such delicate topics.
Right.
Timing is everything. Flexibility, control is everything. And when you go into this next phase of life where now it's all about unwinding, what you all have worked so hard to accumulate for 30 or 40 years, taxes are often the biggest thing that we need to solve for. I always tell folks income is what everybody needs in retirement, but it's almost what nobody wants, because nobody wants the taxable implications of income.
Right.
But everybody needs cash flow. So that's really what financial planning is about. And that's what I set out, and I'm sure what you set out, Jake, to do with your clients. It's how do we replace that paycheck in a world where it's not just all hitting our clients as this big, like, ticking tax time bomb. So critical decisions that you need to make, folks. And there's really a pivotal time when you go from those high earning income years into those retirement years. So have the conversation about Social Security and Roth conversion planning and how to get out in front of RMDs and whether to delay Social Security. And again, if you're working with a financial planner, I'm sure those are conversations that you're having. And if you're not, well, we would invite you to come have that conversation with us. So Jake, we have a resource, don't we?
We do. We have a booklet on Social Security decisions, talking about the timing, the impact of the larger plan, along with how do you get the most from Social Security. So if you'd like to get your hands on that complimentary resource called the Social Security Decisions Booklet, simply text the word social, SOCIAL, to 800-757-0436. Again, just text the word social to that number, 800-757-0436. We'll send out to you free of charge the Social Security Decisions Booklet that we have, a complimentary resource just to put some information in your hands to figure out what do I need to do with this information. That information's in our show notes as well. Well, I tell you what, this is a great launching point, and I think that this is an invaluable subject because every one of us have to reckon with these decisions. And what you'll find is when you get your hands on a resource like this, or we talk about an idea like this, you're going to find that there's a commonality, which is decisions around pension timing as well, right? Because they're both similar things. They're both private annuities, effectively, which turn lump sums of money you contributed into a guaranteed income stream. And so the timing of it is so important, and it matters to your bigger plan too. But let's do this. One of the things we've implemented recently is a little bit of a fun corner of our episode, if you will. We call it the Mailbag Minute. And so I'd like to take a look at some of these Mailbag Minute questions. Instead of spending like 10 or 12 minutes on a subject, we want to hit these rapid fire 60, 90 seconds. I'm not good at giving 60-second answers. So I'm going to ask the questions, and Nick, you answer the questions in 60 seconds or so. I certainly will give you patience if you go over it, and I won't cut you off. So for a lack of better timing, let's go ahead and hop into question number 1. Our first question related to today's topic is, and you'll notice this is related to the big picture of Social Security. How do my wife and I, this is written by a husband, I take it, somebody out there, how do my wife and I figure out how much tax is being taken out of our Social Security benefits?
Yeah, good question. I mean, you need to look at the statement. When I say statement, I don't really mean the statement. I mean, you can go to the SSA.gov website. You can all log in to where it says My Social Security. There's going to be a withholding form. And if you don't see that form, or if you don't ever recall having filled out that form, chances are are, you're probably going to get a bill at the end of the year saying that you owe some taxes on your Social
Right.
Security. So there's a few options. It's somewhat limited as far as what those withholdings can be from Social Security. But I would encourage everyone to make sure, unless you're ready to pony up a chunk of change at the end of the year come tax time, make sure you're withholding benefits from your Social Security. So I know it's all good to see, on that statement, oh, I'm going to get $3,000 a month, but then you get that first check and it's only, $2,200. Well, why is that? Taxes, Medicare premiums, other things that, you need to be aware of. So again, the easiest way to figure out how much taxes are being withheld, you can call Social Security. You can log into your Social Security portal on the website. You can make any changes you want. You can download the form. I think they also allow you to just make that election electronically online. But yeah, call the administration or go to the website.
There we go. All right. Question number 2 related to Social Security. This is a specific question. In the 6 years before becoming eligible to collect Social Security, I did not work. Will my benefits be reduced as a result? That's an interesting question.
It is, yeah, and it can be a little complicated. When you look at that Social Security statement, they're going to assume, let's say, this person is 56 years old, and they're not working for the 6 years prior to collecting their Social Security at 62. When they look at their statement, that number at 62 is going to assume that they had their same earnings record from 56 to 62, when in this viewer's case, we know, or I guess in this viewer's question, we know that that is not the case. So the benefit they receive will be slightly lower. They're not going to be, quote, penalized for not working.
Right.
It's just they have less working years going into the system. So the way that they calculate it, it's the average of the highest 30 years of someone's earnings records. And if there aren't those last 6 years on there to knock out potentially those first 6 years, where I'm sure there would be a discrepancy in income, that's where you're going to see that reflected in a lower benefit than what that statement actually shows at 62. But no, you're not being penalized. It's just, less money going into the system, which means, a little less coming out at the end of the day.
Good answer. All right. Last but not least, finally, we have a little bit more of a general question that most people, I think, want to know whether they're interested in Social Security or not, which is, how do I lower taxes in retirement? Man, that is the $1 million question, I believe.
It sure is. And it's at the core of what we do. And how you lower taxes in retirement is by having more control and more flexibility when it comes to where you're generating cash flow from. I didn't say income, folks. I said cash flow, right? Anything that comes out of an IRA or an annuity or a pension is going to hit you as income. Income is going to directly result in taxes. Cash flow, however, we can be a little more strategic as far as where that is coming from. So that's really the core behind all the plans that we do, all the conversations we have with our clients. Again, I can't stress enough the difference between just investment management. What a lot of folks listening can go to, basically any institution and probably get for free. I can't stress enough the differences between investment management and what we do for our clients as financial planners. Investment management is part of it, but it is only part of it. And if all the conversations you're having are just about this stock or that bond or rate of return, you could really be missing out on 9/10 of the actual conversation that you should be having from a financial planning standpoint. Questions about income, taxes, expenses, legacy, gifting, of course, growing your money. It's a very, very different phase of life. And when you get to this point where the game is changing, you often need to change the way you're playing it.
Yeah, that's well said. Extracting your money is a lot more complicated than building your money. And it doesn't mean that both don't take hard work. It just means that growing your money is a little bit more set it and forget it. And extracting your money is a whole lot more complicated. Well, I think that this was a great informative episode. I learned some stuff. I appreciate that, Nick. Thanks for always being a sharpening tool there. And I tell you what, one more time, just as a quick note, you can get your hands on that Social Security decisions that all these questions have sort of surrounded, that Social Security Decisions Booklet, complimentary, free of cost, by simply texting the word social to 800-757-0436. Again, that information is in today's show notes. Thank you so much for tuning into the Money Wisdom podcast powered by Johnson Brunetti. We appreciate you being here. We appreciate your questions. If this content was helpful, make sure to give this video a like, subscribe to our channel so you see more, turn the notifications on if you're watching on YouTube or one of your social media or podcast platforms, and make sure to share if you have a friend that would be benefited by this. We'll talk to you next time on the Money Wisdom Podcast.
Johnson Brunetti is a marketing name for the businesses of JB Capital and JN Financial. Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.